Do you have a tough time deciding whether you want to add value or growth stocks to your portfolio? Are you unsure which one is even right for your portfolio and what the risk profile is like? Well, that's where today's video comes in, and we're going to teach you guys all about value and growth stocks. As you can see, Warren Buffett plays a big role, and he's a big advocate for value stocks, so we're definitely going to take some time and understand why he prefers these, and of course, how he made his fortune doing that. We're also going to take a look at under and overvaluation. This is a huge component of looking at value and growth stocks because how they're valued is actually linked to whether they are a growth or a value stock and can actually help us to decide if the price that's currently being allowed in the market is actually the proper price where we should buy. So I hope you guys enjoy this one. Stay tuned through the whole video. It's a great video. We have some examples at the end. Share with your friends, and as always, have a great week, and I hope you learned something new. All right, let's get started. So, investing like Warren Buffett, how do we go about doing this? And what exactly does he enjoy investing in? Welcome back, everybody. In today's video, we're going to explore the age-old question that many investors and traders have asked, which is, should you consider value or growth stocks for your portfolio? Should it be strictly one or the other? Should it be a mix of both? Let's discuss. So this question has plagued investors for years, and even investors like the legendary Warren Buffett has weighed in on the debate. As Warren Buffett famously said, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And this couldn't have been better said. So what this does, this statement, is it highlights his preference towards value stocks and getting them at a good deal. But why does he prefer these over growth stocks? How can we determine what the wonderful price is in order to buy such a stock? And how can we determine its valuation based on this? So first things first, let's talk about what each one is in turn, and we'll start with growth stocks here. So these are typically small cap, meaning a market capitalization of under $2 billion, which is the total company size. Companies that are focused on, surprisingly, growth. They're focused heavily on the idea of reinvestment into the company, rather than their profitability. So due to their extreme growth potential, growth stocks tend to have very inflated PE ratios. Now, what is a PE ratio, you might ask? Well, here's the equation that'll help you understand. So essentially what it is it's the stock's price per share divided by the earnings per share. And this is just total earnings divided by the number of outstanding shares, or EPS. And we can note here that EPS uses earnings from the preceding 12-month period, which is also referred to as the trailing 12-month, or just T12. Many analysts use the high PE ratios in order to conclude that growth companies are indeed overvalued, are subject to correction because of this. Investors who prioritize capital gains over income potential have a higher risk tolerance and definitely have a longer time horizon, might prefer investment in these kinds of growth stocks. However, if growth stocks are also known for their risk, and as a measure of their risk, we have beta. And if we want to see an example of how beta is defined, check out our Portable Alpha video linked here. And it's often much higher than the S&P 500 index, which speaks to their volatility. This means that their beta is often above 1. So next, let's talk about value stocks. These are stocks that are currently very undervalued based on their fundamentals. These kinds of companies may be in decline, they're usually old-standing companies and backbones of the economy, but they still have strong earnings and therefore subsequently offer investors large dividends in order to attract them. But unlike growth stocks, however, value stocks have much lower PE ratios and are often seen to be undervalued for their cash flows and profitability in their field. Investors who prioritize immediate payoffs through the payment of dividends in terms of income, a lower tolerance for risk, and a shorter time horizon for investment, such as people nearing retirement or needing it for a specific occasion, and are skilled when it comes to identifying stocks like this and have some background in investing, might prefer to invest in value stocks instead. Value stocks are often associated with undervaluation and often offer a market beta that's below 1. What this means is that they're much less volatile than the market at large and therefore also offer less risk. So now how do we determine if it's over or undervalued? That's the big question. How do we know if it is overvalued or undervalued at a given point in time? We can look at the most basic level and we can use the PE or price to earnings ratio and further use it to compare that company to ones similar to it. And we'll do some examples here in a second. Growth stocks tend to have high PE ratios, as we've mentioned, compared to similar companies, and therefore are overvalued, whereas value stocks have PE ratios lower than similar companies and are seen to be undervalued. And this is kind of the premise of how we want to compare to similar companies in order to determine over or undervaluation. Similarly, there's also the PEG ratio, which is the PE growth ratio, and which actually compares the PE ratio to the company's growth in earnings per share. It can be used to determine potential over or undervaluation as well. So a PEG ratio greater than 1 indicates that earnings growth is accelerating and therefore overvalued. If it's less than 1, it might indicate that growth is decelerating, as is commonly the case with value stocks, and therefore is undervalued. The PEG ratio is calculated as PE divided by G, where G is the growth rate of earnings, and we'll add that in a second here. Now the EV/EBIT ratio, which further accounts for a company's debt interest and taxes, can also be used in a similar fashion. A higher ratio suggests overvaluation, and a lower one suggests undervaluation, very similar to the PEG and the PE ratio methods. Okay, so now what's the verdict? What does all this mean? Investors who are dedicated to determining a stock's value can further conduct a full discounted cash flow analysis, and this will be probably the most accurate in order to determine if it's over or undervalued. So we have a great template for you guys to use. If you want to use it, the link will be in the description down below, and we have a shared driver where you can use this file to do your own DCF valuation. And we'll of course be doing another video with an example on how to use this to value a stock fairly soon. So DCF valuation requires extensive financial data, which is one of the downsides, as well as some of the assumptions in order to execute it, but regardless, it can provide the most accurate assessment of whether a stock is over or undervalued at its current price. In conclusion then, understanding your investment style and determining which type of stock, either growth or value, whichever you choose, is right for your portfolio is crucial. And if you're somewhere in the middle, you can incorporate both these into your portfolio as well. That's also completely fine. Now, learning to determine when a stock is over or undervalued is a crucial skill, and with some level of accuracy, you can save a lot of money in the long run. So whether you prefer growth or value stocks, remember to always do your research and analysis using the tips in today's video to invest more wisely. So we'll see you guys next time, and we'll dive into some examples right now. Some examples here. So let's take a look first at some very high PE ratios to kind of get an idea of what kind of stocks might be overvalued. Of course, Tesla has fallen a lot in the last year or two. You can see this here, where it's kind of dipped a lot, but even when it was way up at its peak, the PE ratio was so overvalued, and you can even see that here. So this means that the price of the stock right now, so $195, is about 53.9 times as high as the earnings per share, which is pretty high. And of course, this is going to be higher for growth stocks, for technology stocks. That's normal. But when we see it getting too high, it's a bit worrisome for us. So we can start by looking at something that's a typical growth stock, which would be something like AMD. So Advanced Micro Devices, these specialize in making different kinds of graphics cards and CPUs, and they all work with silicon and stuff like that in Silicon Valley. And they make semiconductors, that's kind of their main business, and have been really affected by that supply surge and fall in the last little while. So we can see here in the 5-year chart and even in the max chart here that we have huge exponential growth between about 2016 to its peak in about 2021, which is only about 5 years, and it's pretty crazy how quickly it's grown. So that's a good indication that it is in fact a growth stock. And we can see this crazy PE ratio here. But what's interesting is that when you look at other companies like this, so for example, if we take a look at Nvidia here, which does very similar in terms of what it does in terms of the market, we have a PE ratio of 137.28. So we see that it's pretty normal for these PE ratios to be a bit higher because they're reinvesting all of their money into the company rather than paying dividends and taking the profits out of the company. So again, here you see that huge growth between about 2019, this is even more recent, to its peak at about 2022, early 2022. So pretty crazy how quickly that's grown, and again, a good indication that it's a growth stock. So you can compare these with, say, about 10 companies if you can find 10 in that similar industry. And using this, you can kind of get a good scope of whether the company you're looking at is over or undervalued based on those PE ratios. You could even use the PE ratios of all those different companies you find to find an average, and if the one you're looking at falls above or below the average, you can get an idea whether it's over or undervalued based on the subset you're looking at. So now, to look at Warren Buffett's favorite class of investments, let's take a look at some value companies. So this is stuff like Coca-Cola. This is one of his favorite companies of all time. You can see it's had fairly stable growth, but nothing crazy or exponential. And it has a PE ratio of about 27. So you can see it's a lot lower than for some of those growth stocks. Similarly, we can also look at Pepsi, which is very similar. And you can see it's pretty much in line. We had 27 at Coke and 26 for Pepsi. So this gives you a good idea that these are fairly equally valued. Again, these might be a bit trickier to find comparisons for, but even companies such as Ford, for example, we can take a look at, which is a known value stock. You can see their PE ratio, oh, it isn't actually recorded here, so we'll find a different one. So if we do General Electric, you can see this PE ratio is still pretty high. And again, this could be due to recent times where they've had lower earnings or their prices skyrocketed, but it's not always consistent. So this is something to keep in mind as well. Finally, we can take a look at like McDonald's here, which is another one of Warren Buffett's favorite companies. You can see that PE ratio, again, is pretty much in line with Coke and Pepsi, which were also value stocks. So you see that this is pretty in line. So that should tell you something about General Electric and that it's a little bit overvalued currently, for whatever reason it might be. So use these tactics if in your portfolio, just as like a simple comparison. We're also going to do a video on a full DCF or discounted cash flow model, where we're going to just walk through how to value a company and determine if it's over or undervalued using those ways. So thank you guys for sticking around. Share this with your friends, and I hope you enjoy this one.